네, 최근 주식시장에서는 그동안 많이 올랐던 반도체 종목들 그리고 빅테크들의 주가는 떨어지고 그동안 오르지 못했던 중소형주들이 약진하는 흐름을 보이고 있는데요. 이런 순환 매장이 언제까지 이어질 수 있을까요? 또 그렇다면 이 빅테크 종목들은 잠시 쉬어가는 중일까요? 아니면 시장의 주도권을 완전히 중소형주에게 뺏긴 걸까요? 오늘은 이런 질문들을 이 댄스즈키 리처드번스타인 부CIO에게 물어보도록 하겠습니다. Hello, Mr. Suzuki. Thank you for speaking with us. Yeah.
Hello, thanks for having me. I'm excited.
So now we've been seeing the rotation in the market recently. So how longer can this continue, you think?
Yeah, I think there's a lot of room for this rotation to
Mhm.
continue. Now, obviously, I don't think it's going to continue in a straight line. It's going to have the usual fits and starts, but I do think there's a lot of room for this rotation to run. And the reason is there's a lot of fundamental reasons and support for the
Mhm.
rotation that you're seeing today. On one hand, the market has, a small group of companies that are very good companies with strong earnings growth, but that earnings growth is slowing. And at the same time, valuations are high and expectations are also very high.
Mhm.
Now, the rotation has been into sort of everything else. And then that's where you have a lot of companies where earnings growth is much weaker, but that earnings growth is accelerating and picking up. And you're seeing more and more companies put up better and better growth. And for those companies, by and large, expectations are low and valuations are also cheap. And so it's just a much lower bar for them to beat. And so I think,
Mhm.
this is just the early stages of a rotation that, over the next couple quarters, you should see a big acceleration and broadening out of earnings growth. And I
Mhm.
think that'll continue to support the rotation that you've already started to see.
So you think that this kind of rotation can like last longer than people think?
I do. I think obviously it's been very fast and very aggressive, and so at some point you're likely to see it take a pause. But I do think because of the fundamental support over the next couple of quarters, there's a lot of room for this to run. But one of the key necessities or ingredients for this rotation to continue is that the earnings growth comes in as expected. So for the big tech earnings, what part of this is going to be that their earnings growth is likely to continue to slow. So you need to
Mhm.
see that actually happen, which I think is likely. And at the same time, you do need to see this big acceleration come through for the rest of the companies like small caps and emerging markets. If they continue to disappoint, which is what they've been doing over the last few quarters, then perhaps this rotation doesn't have as long as we might think.
If so, then how about the big tech stocks? Like, are they just taking a breath, or has the market completely shifted to the small and mid cap stocks from the big tech?
Well, again, I think it really comes down to growth. And so what you're seeing is while the growth numbers for these big tech companies is very strong and continues to be strong, the rate of change, the growth rates are actually starting to slow. So they've already peaked out in most cases a quarter or two ago. As those continue to slow, I think, against the bar for expectations, which has continued to get higher and higher, it's more likely that you're going to see disappointments, even off of really good growth numbers. And so I think it's more than just a pause, so long as you see the other companies, actually pick up the slack and show better earnings growth, which is something we haven't seen for a while.
If so, which sectors are the most promising in the current market rotation?
Yeah, I think ultimately the sectors where you're going to see that earnings acceleration come through very strongly in the next quarter or two, and where expectations and valuations are very low. If you think about the market, a couple examples of that would be, small caps. It's been one of the biggest sources of this rotation we've seen is small caps, and that's because expectations are extremely low, valuations are extremely low. They might see some of the biggest acceleration of any part of the market this year. If you believe the analyst forecast, you're going to see deeply negative numbers for earnings growth going to deeply positive numbers by the end of the year. So I think small caps would be one area. emerging markets, after several years of very weak earnings trends, you're actually starting to see those earnings growth numbers pick up for emerging markets as well. And for most emerging markets, those valuations are quite cheap. From a sector perspective, which I think was your original question, I think some of the non-tech cyclical sectors are also very reasonably priced, whether that's energy or materials or even industrials to some extent.
So talking about the emerging market, do you also think that like not just within the market, but like global rotation can be happened soon?
Yeah, I think so. I think one of the big drivers of everybody moving into the US was, the strong performance for the mega caps. And so to the extent that that's not going to be the big driver, I think there will be beneficiaries on both sides. I think, within the US, you'll see the rest of the market do well and gain some flows. But I think there's also opportunity for other parts of the world, in particular emerging markets, because I think when you think about the earnings cycles around the world, it's not as synchronized as it usually is. So you have some profit cycles that are rolling over and weakening, and you have some that are accelerating. And so emerging markets is just one example of a profit cycle, which is in the early stages of its recovery.
So like if you pick like one or two company within the emerging market, which country is most promising in your opinion?
I think you want to own a broad exposure to emerging markets here. But on the margin, the areas where you're seeing that acceleration come through and the early with more runway for earnings growth, I would say is sort of Asian emerging markets outside of China. China has been accelerating for a while, so it's further along in its profits recovery. But other emerging markets within Asia, I would say, are earlier on in their recovery, so there's more runway for earnings growth there.
So let's talk back to America, US stock market, and with the second quarter earnings season is started. So how do you think it will affect to the stock market overall?
Well, I think it's going to be a really critical earnings season. As I was alluding to before, a lot of the fundamental rotation is contingent on this earnings growth story coming through for the rest of the market. And so I think, this is going to be critical to see whether, the small caps or the other cyclical sectors, can put up that really good earnings growth this quarter. So long as these companies are able to put up those earnings numbers and show that acceleration or improving trends, I think you'll see not only that be supportive of the overall market, but in particular these areas and these opportunities in this rotation that you're seeing today.
And one of the biggest reason for the market rotation these days is maybe the like market's expectation about the interest rates. So let's move on to that topic. So inflation has slowed in second quarter, and the Fed expects inflation to continue to move steadily toward 2%. So do you agree with this outlook?
No, I think steadily toward 2% may be a bit of a stretch. I mean, if you think about it, headline CPI in the US is at 3%, which is exactly where it was a year ago. So already you're not seeing the steady march toward 3%, but clearly, the underlying data behind that is coming down. And so I think it's more likely than not that you'll see that CPI number, the inflation number, continue to come down. But I don't think it's going to be in a straight line. And I don't know that we're necessarily going to get to 2%, but we don't need to get to 2% for the Fed to start cutting rates. So the market is pricing in a little bit over 2 rate cuts in the US for the rest of the year. I think maybe it's going a little bit too far. I think 1 to 2 cuts is probably a reasonable expectation. And beyond that, whether they surprise, do one more cut than that or one less cut than that, I don't know that it actually fundamentally matters a lot.
Market now think that maybe there will be a 6 rate cut within a year from now on. So maybe you think this is a little bit ahead of the timing.
Yeah, I think that's very possible. On one hand, if you think about the real policy rate adjusting for inflation is around 3%. So clearly it's very tight and there's a lot of room to lower that real policy rate from here. If you think of neutrals in and around 0. That being said, I think ultimately they're going to move down the path toward cuts until they see signs of reemerging inflation pressure. And so, depending on which way growth breaks to the upside or to the downside, I think that'll ultimately be the determinant of whether, 6 cuts is too aggressive or not. I think in order to see 6 cuts, you really do need to see inflation, continue to trend towards zero, and also, growth remain quite tepid or slow even further. I don't know that that's actually going to happen that way. So I think that there's probably risk to that 6 cuts.
Maybe still you think that like Fed will cut interest rate in September because that's kind of everyone thinks so. So do you agree with that?
I think that's as good a guess as any. Beyond that, I think it's really going to depend on the data. So I think penciling in September as the first cut makes sense to me. But I think I wouldn't put all my eggs in one basket, depending on how the growth data comes in between now and then.
So as Chairman Powell mentioned, one of the biggest factors influencing the timing and path of the interest rate cut is the labor market, not just inflation. So do you think the labor market is cooling slowly, or is it kind of on the verge of sharp slowdown as some of the market fear?
I'm more in the camp that it's slowly cooling. I think you could make the argument that a lot of the cooling and the slowdown that you've seen in the labor market is mostly a reflection of normalization. In post-pandemic, we had these unsustainably strong labor market, unsustainably tight labor market, and now we're only just back to kind of where we were from a labor market tightness perspective as we were pre-pandemic. So now that we're kind of at more normal levels, I wouldn't be surprised to see a further cooling of the labor market, but there's nothing in the growth data or the labor data that suggests to me that we're, about to see an imminent sharp decline or collapse in the labor market. So I wouldn't expect it. I think there's actually some good support for the labor market here.
My last question is, what do you see as the biggest risk of investing in stock market at this point?
Yeah, I think that the biggest risk, and you've seen it a little bit over the last week or so, is that you have a historically concentrated stock market. And so really, no matter what, major benchmark you're using, you probably have a lot of exposure to a lot of these sort of mega cap stocks, and those mega cap stocks are very expensive. So it doesn't take a lot with expectations that high to see a big re-rating and cause a lot of volatility in people's portfolios and at the market level. So I think that those concentrations and the high expectations, it makes for a higher level of fundamental risk, and that's probably the biggest risk out there.
That kind of risk now makes a market's rotation too.
Yeah, I think that's a big driver of the rotation is people are waking up to, just how much risk that they have that they probably didn't expect because they think that they have a very diversified portfolio. But clearly that's not the case. And so I think as people look for better diversification, that could support further rotation from here.
Yeah, thank you for sharing your valuable opinion.
Yeah, thanks for having me. Hopefully we can do it in person next time.